Welcome to Tales of the Tape, live from the Hood Summit 2025. So, U.S. options are on track for their sixth record year. We're looking at growth of about 20%. This is 4 times the level of activity we saw pre-COVID. Basically, there have been seismic changes in the market and the way the market works in the last 4 years. So we have an amazing group of experts to talk to today, and I'm going to go ahead and have them introduce themselves, and then we'll get rolling.
Great, thanks, Henry. So my name is Cathy Clay. I'm Global Head of Derivatives at Cboe Global Markets.
Steve Quirk, and again, thanks to Cboe for being here. I'm the Chief Brokerage Officer at Robinhood.
Mandy Zhu, and I head Derivatives Market Intelligence at Cboe.
Awesome. So, Steve, let's start with you. Your background includes time on the floor,
Yes,
right?
Cboe.
And awesome. So, tell us kind of what that experience was like, and also kind of how it's led into where we are today. And I want to really know, did you think, a couple decades ago that we'd ever see 25 million contracts a day in retail activity in the listed options?
No, I did not. I really didn't. So I actually started at the CME, but shortly thereafter I moved to the Cboe. Spent most of my career in the OAX, and did move around a little bit to a couple other pits, and then even traded upstairs. But it was probably 15 years that I was on the trading floor. There's a couple things. I would have never thought we've seen the explosive growth. I mean, I traded a lot of options. I was mainly an option trader. So, the narrative back then was, oh my God, they're so risky, I should buy a mutual fund. And, I think over time people started to understand all the utilities for options, both from income generation, protection, and just as a more capital efficient way to express opinions on things. So it doesn't surprise me that they've grown. I just didn't think they'd grow this much, it's been amazing. It's awesome.
Gotcha.
But
Cathy, you were on the floor as well.
I was actually on the floor for 16 years. I think I got you beat by a year there, Steve. So yeah, I started on the floor on the Peak Coast in San Francisco, which is now owned by the New York Stock Exchange.
And how did what you learned there and kind of that formative period play into your role now running global derivatives for Cboe?
Yeah, I think as anybody who's been in the floor environment, what that really means is you're standing in the midst of a lot of energy, a lot of action. It's dynamic. And so I think anytime you have that experience, you can't help but bring those traits into any role you bring. So you want to go fast, you want things to be at pace, and you realize that you have to be adaptable because everything's going to change. And certainly the markets from our time, yep, Steve, have really changed over the years.
I think one of the things that is, if I look back and say, what are the, there's a lot of things that I think are really beneficial with starting your career in an environment like that. But I think one of them is you have an understanding. Most people don't come into a career and say, oh, if I can just be right 51% of the time, I'm going to be a winner. They think, oh, I'm never going to be wrong. That's what I should do in my career. But once you understand that, and you quickly learn that in the world of trading, now you have a little more liberty to be more decisive with decisions. I will tell you one thing that my wife will make fun of me a lot for. When you start your career in the world of trading on a trading floor, you are decisive. When we go to a restaurant, I'm like, doom, doom, go. That's it. And they're all like, oh, should I have this? Should I have this? Should I have this? I'm like, and I use this, I love this phrase with my kids. I'm like, the road of life is paved with flat squirrels. Pick a side. It can be the wrong side, but you can go back to the other side. If you sit in the middle and you're paralyzed, you're going to be flat. And so you should, even if it's a wrong decision, go to this side of the road, because you can always go back to the other side of the road.
Looking like a trader.
I just think decisiveness is really important.
I agree. And Mandy, what's your background? You're coming from a slightly different field.
Yes, I joined Cboe 2 years ago, and before that I spent almost 15 years on the sell side, and most recently leading derivative strategy at Credit Suisse. So a little bit of different perspective, not on the floor, but more on the sell side, facilitating mostly institutional flow, although we did see a fair amount of also private banking, retail flow as well. Yeah.
Okay. And did that give you kind of a window into the use cases and strategies that some of the institutional players were actually putting to work, that on the floor we would see the other side of, and we'd say somebody's buying 10,000 puts, I don't know if they're worried about the market or it's part of some other structure.
Yeah, no, I liked it because you get to talk to the end customer and really help craft the strategy and the trade and walk through kind of the risk rewards. And a big part of my job was coming up with trade ideas and generating those trade ideas for a variety of clients. You have hedge funds, you have asset managers, insurance companies, and what they trade and the end objective can be very different.
Gotcha. I mean, I had my time on the floor as well. I clerked in OEX and used to have to run through that little tiny aisle where everybody's elbowing you to go pick up the paper tickets. It was a lot of fun. But fast forward to today, it's a very different marketplace, right? I mean, Robinhood is one of the largest retail brokers. How have things changed, Q, in terms of this user base, which, to me, it kind of feels like it came out of thin air,
yeah.
But I don't really think that's the case.
No, I don't think it came out of thin air. I think if you would have asked me 10 years ago, and I don't know, you guys might be in the same boat. If one of the largest retail brokerage firms for option trading was all being done on a phone, I would have told you you're crazy. I just don't think that the capabilities are there to be an efficient option trader if I'm just using a phone. But that's where technology has us today. Mm-hmm. It's pretty amazing. And I just think, the young customer, our customers are pretty young, they're in early 30s. They're really savvy. So they know how to take advantage of opportunities. They know how to be more precise. I'm sure we're going to talk about it, but it's all the rage is the shorter dated options. The simple analogy I always use with this is, look, if I've been holding an Apple position and I have 40% gains in it, and I know there's one day when that might be jeopardized, why would I buy an option for a month? Mm. You know what I mean? It doesn't make sense. So I think the products that you all have been rolling out are in response to what customers want. I think there's sometimes a narrative that, we as brokers and you as an exchange are rolling these out, and so for that reason, customers are doing this. No. That's what they want. We're catering to our customers, is what we always do. So it doesn't. I mean, as I said, as we started off, it doesn't surprise me about the growth. It surprises me about how fast that growth has been.
Yeah, I agree. I actually looked up. So this year we're running average daily volume near 58 million contracts. When I started in the business in the early 90s, average daily volume was about 1 million contracts a day. We traded that in the first 2 minutes today. Wow. So it is just a different world and a different customer base, as you said. Cathy, for you, so Cboe, we have the SPX index, which is the most popular institutional hedging product. And then we also know that it's very, very active for retail as well. So, in terms of running the show, how do you keep both of those user bases happy? Because I assume they have kind of very different needs.
Yeah, they do. But, the SPX is a great example of where you see high institutional adoption of a contract that is broadly used to hedge portfolios, because it is the S&P 500 after all. But then you also see almost half the volume in the SPX coming from the retail trading community. And so that's a really interesting dynamic to hold together, that it's a very institutional product, but it actually serves retail quite well. And as an exchange, our job is really to make sure that the markets are transparent, that they're liquid, and that investors have a great experience on our markets. And so we really do various things through market structure and features, through pricing incentives, to try to strike that delicate balance so that all participants can come into the market and have a fair shot at expressing their opinions and speculating and hedging. We all want it to happen, and it's our job that we take very seriously the high integrity markets that are transparent, both in times of stability, but also during times of high volatility, need to be able to get in and out of positions. So that's what we really focus on, is making sure that experience for all participants has high integrity.
That's great. Now, we mentioned short-term trading and zero DTE trading. Mandy, what can you teach us kind of about who's trading these options, kind of how they're different from longer dated, and just kind of what's going on to be driving this, 1.6 million contracts a day of SPX zero DTE?
More than that now, over 2 million.
Okay.
No, but in terms of, it is actually a very distinct market, if you will, versus longer dated options. So in longer dated options, I would say the predominant use case for, at least for index options, is for hedging, right? But in zero-day options, from the very beginning, we saw very balanced trading between puts and calls, between buys and sells, between the types of strategies deployed. And that tells me that there is not one dominant use case. There's actually a diversity of use cases that we see with zero-day options. So we do see a lot of people use it to speculate, right? Because the absolute dollar premium of these options are so low that it is kind of like a cheap lottery ticket. If I think the market's going to be up or down, I'll go and buy a zero DTE option. But we also know a lot of investors and a lot of traders use these for income as well, because the embedded volatility risk premium is so high, and you're able to actually capture quite a bit of yield with these and doing it systematically. So we do see on both the institutional and the retail side, a lot of traders use these for income. And then the third use case we've heard anecdotally from a lot of more, I would say more institutional investors, is replacing futures exposure. Instead of trading futures now, they'll trade zero-day to expiry options. So those are, I would say, the three popular use cases, but what it comes down to is that you get, a very balanced buys versus sells, very balanced, puts versus calls trading, and that's true regardless of what the VIX is doing, regardless of what the S&P is doing. We saw it 2022 when the S&P down 20%. The same pattern holds now that the market is up. Same pattern held in April when the VIX was at 50. So I think that's actually quite incredible, is just the consistency, the systematic nature of a lot of that trading, regardless of kind of the underlying market cycle or the underlying volatility regime.
Can I ask a question?
Yeah.
Because you just made me think about this, and I'm curious. I don't know the answer, and I also want to give a little plug to Henry, because every time you and I are on the same circuit, conference circuit. Every time you're on, I learned so much. Like, the stats you have are incredible, and I know I speak for others in the option community when I say that. Everybody looks forward to you being on a panel. I'm curious if that same balance exists on single names. I don't know if you guys know offhand or not, but I that's a little surprising to me, so I'm just curious.
It does. It's different. So yeah, I do think zero DTE options, and when we think about expanding it to single names, I think that is one thing that we'll have to grapple with, because in single name option trading currently today, as it stands, we do see more calls trade than puts, and that's pretty consistent. Generally, people trade single stock options for directional view. And that could potentially create imbalances in terms of positioning in the market, but at least at the broader index level for SPX index options, that is not the case.
Because that would be that's reflective of Robinhood. Like in the single names, it is more calls than puts. Yeah, I actually have to take a closer look at how much that skews. On the index side, I don't know, but it piques my interest.
Well, I thought it was interesting in the panel I was on. We did ask by a show of hands how many people had traded zero DTE, and then how many people like to buy those options and sell those options. It was about 50-50. There were buyers out there and there were sellers out there, and it kind of goes into what Mandy's saying, is there are people that use these, the characteristics of a zero-day option, right? There's effectively very, very large built-in leverage, right? It's a decaying option, but the amount of notional value that you're controlling with a $3 call at 3 o'clock in the afternoon. I've done the calculations. It gets up to about 1,200 times leverage. Now, you're paying for that in the form of decay, but people have learned to use this. And then on the other side is exactly what Mandy was saying in the trade that we did as an example, which was an iron condor trade that we tend to see about 50,000 of those contracts trade in that form in the first half hour of the day. So, Cathy, question for you. So, you've been at Cboe, as we added in the dailies and filled it in. The SPX really was the pioneering spot. And we have seen a shift, not just into zero DTE, but into shorter dated focus. What do you think has kind of made that possible? And does it concern you? Does it make you think like, well, maybe the longer dated trade contracts, they're not trading the same way. They're substituting short-term contracts, or is it just kind of a complementary fit?
Yeah, it's been really interesting since we did list the zero DTEs in SPX a few years ago, and we were really cautious to want to see exactly what Mandy's talking about. What was going to be the balance of trading that happened as we added these? We certainly never want to have adverse impacts into the marketplace that affects investors and traders. So we launched the zero DTEs in SPX, and we really just kind of took our time to say, how are people engaging? How are retail traders engaging? What does the data look like? Is there any imbalance that would give us worries about directional spikes because people have too much on one side or the other of the equation. So we watched this for a long, long time, and the data just kept coming back. And Mandy was on the forefront of really watching to see exactly what kind of gamma positions were being, in aggregate, created by the zero DTEs. And we just started feeling very, very comfortable. Of course, we're talking to Q and other of our clients to say, are you seeing these things? How are you feeling with your clients? And then, of course, we expanded the zero DTEs into the Russell 2000. So you took something that was only in the large cap names, now available in the Russell 2. And of course, now the industry is talking about zero DTEs and single stock names. And so, it's always a journey. It's always a maturation of where do we go from, how are we going to get there? How do we make sure that investors are protected, that they do not have bad experiences? Nobody wants a black eye in this industry. There's been, as your stats show, so much great momentum in options trading and options uptake. We would not want to do anything to put water on, on that. So I think, you're going to see things just go more towards the short end of the curve across all different assets. And that's just a reflection of our society for immediacy and gratification. And, we could point to all different areas in our lives where that's our preference. So it's not surprising that's going to be a preference in investing.
But I also think what gets lost, because it tends to be a topic that, again, if you're at an industry event, there's always talk about short-dated options, but they don't talk about any of the other asset classes, and we can see it. The duration of hold on those is shortening as well. It's exactly what you talked about. And I mean, there's some fundamental reasons, like companies, you don't buy a stock and it stays in the S&P or the Dow for 85 years anymore.
Yeah.
Like the world moves quick. Like, look at AI. And so you have to be nimble as an investor, and you have to be nimble with how you invest. And so I think that part, I don't know that changes dramatically.
Yeah, I laughed because when I joined the industry, a 1 month option was considered very short dated. Like typical was 3 to 6 months, and people traded as far as out as 10 year. Like S&P 10-year vol was very actively traded when I started in the industry, and now anything longer than 4 weeks is considered long dated option.
Yes.
Well, and I would say the technology, this wasn't possible. When I started in the business, like the last thing you wanted was an expiring option near strike in your portfolio, because it was just you were manually hedging things, and it was kind of everybody rolled out of these things a few days before. In fact, in the SPX pit, you'd have a conversation. You'd be like, hey, I got the 60-70 call spread on, do you have the other side? And people would very actively, and by the time you got to expiration, there wasn't really anything left to trade.
Yeah.
And I think that technology has made this possible. It's everything's kind of come together at the same time. And I think that Robinhood very specifically also took friction out, by pioneering, no-cost brokerage. Mm-hmm. That also, lowered the hurdle for people to basically break even on a trade dramatically. You also had kind of the efficiencies and the, increasing because technology was making it possible. So that the customer experience becomes like, okay, listen, even if you're not right, you're not getting ripped off just to get in and get out of a trade. And that's when we started. I have very vivid memories of brokers coming in and saying, I need to buy some of these. The price was $1.50, and they came back 20 minutes later and said, oh, I got to get out. And all of a sudden the price was $1. Yeah. And that's we all know that's an unbelievable spread, but that's how things work. Now you're down to pennies consistently. Yeah. And then you also have kind of the whole ecosystem of price improvement, yep. Right? And when Obi was showing the trades we were working today, the fact that customers do get filled better than offer if they're buying things much of the time, mm-hmm. Really also just makes the experience. And that's why I think you see, kind of so much persistent activity no matter what's going on. On the technology part, Q, you and Vlad last night showed off some really, really cool stuff. I was like, all right, that one, the Cortex AI-based charting I was like, okay, there's some real innovative things coming out of you guys. What do how do you see things, going forward? You said in other assets that things are also shortening in terms of duration. What changes do you see, or what developments, I guess, in terms of how people interact, how your client base uses your platform to get into the market?
I think though, we did showcase some things with Cortex, and I just think technology has the ability to really help people in finding instruments or opportunities. And then it helps them, sort of almost create a plan. Like if I have now the ability to, in natural language, do a scan for opportunities and I'm an option trader, now that becomes a watch list and it just alerts me, and I don't have to be looking for opportunities, they're looking for me. I just, I sit back and marvel at where we've come from. Like you said, back in the days when I started, and I'm before you guys, so I'm not going to put you on my age curve. You don't want to be on it. We weren't in decimals. And I just look back and I marvel. Like, you think about how wide the spreads were, how little information or education there was, how much it cost to trade, how poor the quoting mechanisms were. And I just can't imagine a retail trader being successful in that. Yeah.
No.
If you look at it today, you're like, oh my God. Now,
I can't believe we were successful on the floor.
Yeah, that's true. Well, maybe that's why we're here. But now, you have access to content like this. It's amazing, from some of the best traders in the world. You have transparency in education, transparency in pricing. You have the ability to see everything real time. I remember back when some of the equity exchanges were moving from New York to the Cboe, because I was working for a Dutch firm, and they wouldn't let them bring their news sources on. So they basically had to trade blind. It was a New York rule that they weren't allowed to have access to. It was only New York approved news. The exchange approved news that they could use. And I thought to myself, this is the silliest thing I've ever seen.
Wow.
Well, those barriers come. I remember when you weren't allowed to have cell phones on the floor as well. Because, and actually, here's a story. So I worked for Blair Hull for Hull Trading, and we had pagers, which would then show the S&P, the program trading level. And so people's pagers were constantly showing these little numbers. And it wasn't really clear if that was allowed or not, but it became, ubiquitous. And then there were screens in the pit. And then I think we finally got to the point where the exchanges all said, listen, this is making markets more efficient. And, this is competition. And so, I think that's kind of a good march of progress. But, Cathy, what do you see kind of going forward? I know you made some announcement this morning in terms of, meeting the market and kind of where things are headed.
Yeah, so the exchange, we don't go direct to retail. So we count on our partners like Robinhood to really give us a sense about what are your traders interested in trading. And with that conversation and dialogue, we think about product innovation in ways that where are the traders trading today, what can we deliver that they would be interested in or be helpful in their portfolio. So a couple of announcements we made this week really in line with that, thinking about what does the retail trading community want. Yesterday we announced that we were going to be listing continuous digital futures on Bitcoin and Ether later in November to be launched. And really this is a long-term, perpetual type of contract that gives retail traders and others the ability to kind of hold spot crypto without actually having to have a wallet and go through all of that. But there's no, expiries that every month fall off and you have to roll the position, which can be quite costly. Mm-hmm. So these perpetuals, which are very heavily traded offshore, are now going to be available in the U.S. So we're excited about launching that. And then this morning, we launched on the stage just a few minutes ago, the Mag 10, the Magnificent 10 that Cboe is going to be launching, both in a futures product and also in an index product. So bringing that sort of cash-settled profile of, European exercise and all the benefits of index options into the Mag 10. And the other thing I know Robinhood talks about a lot is access. 24/7, you want people to be able to trade when they want to trade in their own time zone or when they can't sleep. And so these products will also be being added to our overnight session. But all of this product innovation comes from talking to our clients that let us know what their traders are interested in trading.
Yeah, but you're good partners in helping us deliver on it. And now we have a delivery every time we're here, right?
That's the pressure now. Let's just be real.
Yeah. It's not just me getting pressure; it's you getting pressure too.
But the market really does seem to kind of tell. We can see, based on the data that's out there, what people are interested in. What approaches people are using to trading, and I think that's it effectively it becomes a little bit easier because you just start asking the right questions and paying attention to what's going on, and you can come up with the next hot thing, hopefully. Mandy, from kind of an institutional hedger perspective, I'm curious, okay, so the retail, world, it really has been a seismic shift, at least over the last 10 years or so. On the institutional side, what things, did you see in terms of different approaches? Is that audience changing or getting more sophisticated about how they're getting in and out of trades or looking at pricing and volatility?
I think a lot of the similar trends, we talk about the shortening of tenors. I know for sure institutional hedging, insurance companies used to buy 10-year options to hedge their portfolio. Nowadays, they're 1-year options or even shorter dated. So when it comes to hedging, everything is moving toward the front end of the curve. And for a lot of hedge funds, for example, to your point earlier, why buy a 1-month option if you're just trying to hedge a 1-day event, right? Whether that's be CPI, whether that's Fed announcements. So when it comes to hedging, I think a lot of things are moving shorter and shorter dated. The other trend that I do see is a lot of the trading is moving more to the exchange. So from over-the-counter exotic products to more standardized, transparent, liquid products on exchange. And I think that's driven by two factors. One, I think the dominant factor is really regulatory. Coming out of the global financial crisis, Dodd-Frank, Basel III, a lot of these regulatory changes have made it really expensive to hold over-the-counter positions, and that's part of the driver. And then the second, I think, is a lot of the innovations on the exchange side, where we're bringing traditionally OTC products to be able to be traded on the exchange, and I think that has been a big trend that I've seen on the institutional side as well.
And that's good because the cost structure of those is just ridiculous, right? When it's on exchange, it's transparent, and people can see it. It's beneficial.
Yeah. And even moving beyond hedging strategies, a big trend that we're seeing in the market right now is these growth and option-based ETFs, right? The payoff, again, is not new. It existed for many, many years in structured products, in insurance annuities, but now it's a standardized, it's on exchange, it's liquid, you can trade in and out, you don't have to hold it to maturity, you know exactly what the cost structure is, right? What the fee is for holding these ETFs. So I think that's a big trend I see, across different investor types and different use cases. Is just more and more trading moving to the exchange.
Well, yeah, and that the explosion in ETFs. I mean, there's some great commentary on Bloomberg about it. We're now actually at the point where there's more ETFs than stocks. So, and that's only going to continue. And it actually makes me think of Cathy. You did a presentation at WIFIC, I think, about everything to everything trading. And can you kind of refresh me on what the concept was?
Yeah.
Is it moving along?
Yeah, it's a little bit of an abstract concept, so bear with me. But really, when you think about how DeFi, TradFi, it's all starting to merge and get a little bit blurry. And the thinking was that eventually, I don't know if it's 10 or 20 years, but eventually you think everything's going to be connected in somewhat of a matrix structure, where people are able to jump on and jump off different rails and exchange pretty much anything of value 24/7. So I actually see a world where my United miles, I might be able to say, well, I want Mandy's Starbucks points. And there'll be an exchange of value because blockchain is going to enable movement of assets and collateral seamlessly. And so I actually think that we'll have a anything to anything 24/7.
Awesome.
I think you're going to see prediction markets play a part in that too.
Absolutely.
And event contracts, because you can create them really fast, and you can create them by demand very quickly. And even the examples you're using, you could create that. It's pretty simple to create those things and then use the technology behind it. Yep. It's going to be, I think it's a good thing. Because, if you think about it, just notionally, I don't know what the average notional trade volume is for a trade, you guys I'm sure know, but where else in the world do you get a penny wide on notional? If you buy a car and then turn around and sell it the next day, is it a penny cheaper? I don't think so.
Nope. I agree. Everything should be that efficient.
Yes.
I want to ask Q, so for your customer base, where do you see, and also kind of for your personal preference, what kind of trades do you think work the best? And what's your personal view? I said during my presentation earlier, I tend to kind of lean to sell Condor Premium. I like that trade. It doesn't always work. Do you have a preference kind of in how you lean, but also kind of how does your customer base, kind of navigate?
My preference is different than our customer base, but I think, and again, you guys would understand this better than anybody, considering your roles, but I think, at least from what I've seen, the way people get into options is, they buy a call on an individual name and experience it, and then, it's Apple, and Apple comes out with great earnings, and they're like, hey, wait a minute, why am I not making money on this thing? Oh, it's got a lot of premium in it, and it's melting away. It's like a popsicle in July, right? So, in my mind, I think having a healthy mix of being both long and short is really what in the long run is probably best for customers, but they have to get comfortable with it. You can be a lot more comfortable with a long option than you can with a short option. But I use this analogy, and you probably use it as well. If I sell an iron condor, right? So I'm selling a call spread and a put spread. There's like 4 scenarios that can happen, and 3 of the 4 I make money. And by the way, 2 of the 4 I'm wrong. Mm-hmm. And so in my mind, I like those odds. Yeah. I just think that's a powerful way to think about it. But I think it's something people got to get their head around, because you're probably going to make less money. Like, in other words, your returns are going to be, they're not going to be chunky. They're going to be maybe more consistent. You're going to have chunky returns if you're buying a call or buying a put or doing something like that where, oh my gosh, I made all this money, but then then I didn't. You know what I mean? Yeah. So what we love to see is more balance. Like it kind of goes to everything, balance, diversity, and in the way people trade, but also the instruments and everything. I think is healthier.
Yeah. Gotcha. And
Cathy, I know you guys do a ton on education in that, which is good, because look, it's as Cathy said, it's in all of our best interest to make sure that everybody's successful, and they can be. But when people start trading in a manner that it is not going to be conducive to their long-term health of their portfolio, then we're all losers.
Yeah, I would just say, we do have the Options Institute, which has been at Cboe for 40 years. I mean, before anybody else was really educating about options, Cboe has been really dedicated to educate that end investor. But now we've expanded the Options Institute into Europe, and then this year into Asia Pacific, teaching courses for free, always, in various local languages. So it's just really powerful, as you're saying, Q, to make sure that we're educating the new trader to the sophisticated trader. There's always a journey to be on to improve learning.
Well, and it's nice to see. I mean, when I got into the business, I was told, don't take that job by my dad, who said options are gambling. Luckily, I still took the job. But, just kind of seeing the evolution where it's their tools, right? It's sometimes I say an option's like a chainsaw. You can really get hurt if you don't know what you're doing with it, but it also makes things much more efficient. So that's but the education part, I think, was always challenging. A lot of the brokers just were like, we don't understand it ourselves, and we're also kind of concerned that customers will get hurt. And I think we've kind of gotten over that hump because the Options Institute and firms like Robinhood that embrace it and say, listen, we will teach you how to do this. And I think people are a little less stressed about the liability of the whole thing. So
I have a better one for you that I always like to use. Mm-hmm. I think options are like a fork. Virtually everybody uses a fork. But if you just looked at a fork, you said, I could stick it in my eye. We all know not to stick it in our eye. So if properly trained, you can do really amazing things with options. And most people are properly trained. So, the onus is on us, to make sure people use them the right way.
Exactly.
Yeah. Mandy, from your perspective, in terms of the institutional use, in your history, where did you see the most success? Right, somebody buying a put to hedge their $1 billion S&P, tracking portfolio, they know they're probably not going to make any money on the put. That's the whole point.
Yeah.
But what kind of interesting things did you see, without getting into super crazy quantity dispersion strategies, which are cool but hard to understand? Where did you see kind of customers doing the best in the institutional level?
So to be honest, I think sometimes the most successful trades are the simplest. Right? I think, especially for institutional investors, you can get really funky, really complex in terms of where you're trading relative value, one underlying versus the other, or you kind of mentioned dispersion, where you're trading the index versus the constituent single names. The payoffs, you can do basket options. It can get pretty exotic, but honestly, I think the again, kind of the trend that we've seen in recent years is simpler sometimes is better. Sometimes a well-timed put spread, call spread into the market, you think it's going to rip by a 0 DTE on SPX, that could be the better trade versus a VIX versus SPX relative value, and adding some dispersion element to it. I think that, at least in my experience, sometimes the more complex trade, so many things can go wrong. You're relying on historical correlation patterns that may or may not hold, and just sometimes the liquidity of getting in and out of these like really funky things, the bid ask you're paying, makes it quite difficult to monetize.
I remember this specific example because we used it. This was 07, 08, 09 when the world was kind of ending a little bit, and I think GE got down to like 574 or something like that. And at the time, the 5 put was trading close to $1, and the 6 call was trading close to $1. So, like, if you just sold that put, and you did get assigned the 6 put, and then for the next 5 months you sold that call, you owned GE for free.
Yeah. And
like that is not a complex strategy. It's pretty basic, but it just shows the power of being able to utilize, trust me, this was a very volatile moment. You had to be courageous to be stepping in when it looks like everything is, is really pretty volatile and chaotic. But I just think having, the understanding to be able to utilize opportunities like that is really powerful.
Yeah, it kind of goes back to, biases and psychology too, right? It's when everybody's panicking, as market makers, like that is the time, that it's the opportunity you wait for. However, everybody's panicking and it's a very scary moment, and even in April, April was like, oh man, we're down 10% in like a week. Like this market's going down, and yet we turned out to be a dip buying opportunity, which has really dominated the market for the last 10 years. And maybe we'll end on that. So, we have had a very, very strong bull run, right? No matter how you slice it, your customer base is relatively young. I think the average age is in the 30s, right?
Yep.
So, we haven't been through a real downturn. 2022, the market slid, although it was very kind of controlled. So, I guess, what advice do you have for kind of this community looking at kind of how, we have the perspective of decades of watching the market?
It's the opposite advice that you'd expect.
Okay.
Because I was just doing a Wall Street Journal article or interview this morning, and the question was, same question. Like, this market has been on a pretty strong run. Are you guys prepared? Are your customers prepared for what happens, if we turn around? And I said they're more prepared than any brokerage firm because they're in their 30s. If I'm at a brokerage firm that I used to be at, where the average customer age is 58, they're not prepared because our customers are probably going to be aggressive buyers on dips. They have been. I'm not going to say that they're all going to buy on dips, but they're going to be aggressive. So, it's the opposite of what you would think, because to your point, they don't have experience with this. So they're going to be like, oh my God, like we had a dip and I bought and then it dipped more. And I would say, well, then buy more. You know what I mean? Because time is on your side, right? And historical returns are on your side. So I think, customers at a young age have the luxury of being more aggressive.
Yeah, it's same question to you, Cathy, in terms of what would we're not allowed to give advice. What would your suggestions be to kind of investors now who, this has been a heck of a wave, right? And maybe it's just maybe we have another 10% by the end of the year. You can chart the probabilities on Legend. But what's your advice to kind of people that are, managing their own assets and, kind of looking at the landscape today?
Well, I mean, I really think an important night's sleep is very helpful. And so I would say...
But you're giving people products that trade around the clock.
Well, they can nap. They can nap. Take a nap and then get back in.
We all need sleep.
But, I just say, no matter if the market's going to rip or it's going to tank, just don't be over your skis one way or the other. Be able to sleep no matter what the market does. So be diversified, be smart, don't chew off more than you can handle. Just have your risk intact at all times. And if you can get in and out, so liquidity matters in these types of markets. If the market tanks, be in liquid instruments so that you can get out with not too much of a loss. And hope is a 4-letter word. Just be balanced and get your sleep.
And Mandy, what's your advice?
I think very similar. I think there's a reason why the Cboe Our Marquee Conference is called the Risk Management Conference, because that is, I think, the key when it comes to trading options. Options, you can use it to speculate, you can use it to hedge, you can use it for income. There are a diversity of use cases, so just know what your needs are, what your risk tolerance is, and use it appropriately.
Yeah. And have a plan. If the market does something that you think is adverse, just be ready for that and have a plan. Don't wait till that happens. Like you were saying, Henry, when blood's in the street, that's not the time to be formulating your plan. You should have a plan in advance to know if this happens, I'm going to do this. This is how I'm going to engage into the market.
And I just think, if there's one thing you can tell to people who are newer to investing in trading, Cathy's point, you have a plan, you stick to that plan. Because you can always find a reason why you're going to alter that plan if in a scenario when you shouldn't alter it.
Yeah.
In this time, I'm not going to get out of this trade when it goes down this amount. This time, I'm not going to take my profits at this point. It's going to burn you. You're going to make the wrong decision every time. I have a brother, hilarious. I'm in this profession. He's an appraisal and real estate guy. He works for a company. It's one of those 401ks where you can rebalance it every quarter. My gosh. Whatever he tells me, I know he's wrong. I mean, if he's like, I'm getting out. This thing's terrible. I'm going to cash. I'm like, I'm buying everything I can find. I don't tell him that because I don't want to make him feel bad. But yeah, but he is a perfect contraindicator.
Wow.
Yeah, it's I agree, but it's also hard. And maybe you get Cortex to remind me that you said if you bought this stock and it went down 20% that you were out. And I have this fantasy of basically being able to give the AI the agency to okay, I said I was going to stop myself out. Take care of it for me, But at least at first we could have it remind me.
And don't let me touch this.
Yeah. I honestly think, if you fail to plan, then you plan to fail. And if you go in and you say, listen, I'm going to try to make 300% on the upside, then stick to it. Yeah. Or just one of the first things that Blair Hull taught me was listen, you can be a little bit wrong, but as long as you're consistent. Mm-hmm. It's when you're kind of one day you do something differently. Oh, today I'm going to sell an 8 lot, but usually I just sell a 1 lot. But today I just felt a little different. People get themselves in trouble. Yeah. So we're almost out of time. I just any final thoughts from Mandy on down.
No, I think the growth of retail has been a huge trend in the options market, and I'm really excited to see kind of where it goes from here, and then the products and that we're all coming out with, and the innovations we're making on the platform. It's just a super exciting time.
Yeah, I just think it's an exciting time. I think it's a great time for retail customers to be in, investing and utilizing options, and I'm so happy we're here.
Yeah. And I just want to say thank you, Q, and to Robinhood for taking us along to the journey on these summits. It's been amazing to be here, seeing the unveil of the features coming to the products. It blew me away, to be honest.
Thanks to you. You guys are a major sponsor, and we appreciate it.
It's a great event. Thank you. And thank you, Henry. You did a great job moderating.
Thank you.
He always does.
Always does.
Thanks for joining us.